My guest today is Faisel Rahman from the company Fair Finance, and I'm delighted to be able to interview Faisel today. We've already spoken on the radio, but it's the first time we've had any kind of almost face-to-face connection. So Faisel, it's absolutely delightful to meet you, although it's not quite in the flesh, but as near as we've got.
No, it's definitely it's a step up from the radio. Thanks for inviting me, and it's a pleasure to actually see you for the first time.
That's a great pleasure indeed. Faisal, I want to start tonight by letting you talk. Well, first of all, actually, let me just backpedal a bit because when I spoke to you last, I forgot to congratulate you. You've just been awarded the OBE.
Thank you very much. Yeah, I was quite surprised. Yeah, I was quite surprised to get an OBE for services for towards community finance and the work that I've been doing on financial inclusion. It's definitely an honour. I'm tying up whether the honour is actually being introduced to the Queen or meeting Angelina Jolie on the same day, and my wife has put down an ask to meet Daniel Day-Lewis, so we're kind of angling for the same day.
Oh, that sounds wonderful. I bet you have a great time.
Thank you.
And Fair Finance also had an award. You got the Big Society Award, didn't you?
Yeah, that's right. I mean, it's been an interesting year of awards. I think we won two interesting awards at either extreme. We won an award from the Prime Minister, a Big Society Award for our work on kind of social impact and the activities of bringing microfinance to excluded communities in the UK. But at the other extreme, we actually won the Industry Award, the Credit Today Award for the most responsible alternative lender in the sector. So we beat people like all of the Payday firms that entered and various other peer-to-peer lenders. So it's been an interesting year for us as an organisation to win a social and a commercial award at the same time. And I think that kind of sums up what the company's about, trying to balance something between society and profit.
Mm. Well, that's a great start to telling the story. Perhaps you'd like to just go back a few years to how Fair Finance got started. What inspired you to go down such an interesting path?
I think that there is a phrase or a saying that behind every successful man there is an amazing woman, and I have to admit that I think if I'm going to credit anyone, I need to credit my mother, who, I mean, I'm the child of an immigrant, really. My parents are from Bangladesh, and one of the things that does to you is it basically means that you end up watching movies that make no sense, having to listen to terrible poetry, and having to listen to music that really it's not really the kind of thing I'm into. But one of the cool things that my mum did do is that she took me to see an economist, a Bengali economist who'd come to the UK and was talking about empowering women by using capitalism as a force for good. And being a kind of a precocious 18-year-old, I stood up and told him I didn't think he was correct, to which he responded, well, why don't you come out to Bangladesh and find out how to make it work? So I went to Bangladesh. This person turned out to be Muhammad Yunus, the founder of the Grameen Bank. He then went on to win a Nobel Prize, and I spent the next 2 years trying to figure out why I was wrong, and he was so right. And for me, that was probably the beginning of my journey of understanding how you could use money and capital to really start businesses and to help people. And while I did this work in villages in Bangladesh, I couldn't help but be struck by the similarities between things that I'd seen growing up myself of local moneylenders coming to houses and offering access to finance or cash simply because people had no other options, no banks in sight in small villages. And it was no different from my parents. So I think I saw that similarity, and it made me think that I could do something similar in the UK. And I came back, and that was about 15 years ago, where I tried to talk to people about what I thought at the time was a hidden market of millions of people. I didn't realize it would be millions. I thought maybe it was a few thousand, but it turned out to be millions of people who were struggling to access finance. And sometimes when you think about the numbers, they seem a bit bonkers. But if I told you that there were 4.5 million people in the United Kingdom today who borrowed from a guy who came to your door and offered you cash, and was often the second person to see you after you moved into your flat on a council estate, you might be surprised, and you might even be even more surprised that this is a business where the average rates of interest are about 600 or 700%, and the market leader is worth 2.3 billion and employs 55,000 people. An industry that is so large that it sits in the FTSE. It's that big. It was there before the payday industry. It was there before the others. And I suppose what fascinated me was that in this village in Bangladesh, I saw exactly what I was seeing on the council estates in London.
So you say that in Bangladesh there are no banks, they're remote villages, but that's not the case in London. There are banks there. So why? I've got two questions about this, but let's start with this one. Why is the doorstep loan such a big industry when there are banks available? Why aren't people using them?
Sure. I mean, I think that there's an interesting phrase that's been developed, and it's the difference between kind of being unbanked, which is not being banked, so not having a bank account. And if you think about Bangladesh, or if you think about a village in Bangladesh, like clearly there are banks in the cities, but there aren't very many banks in the villages, and that's why many microfinance organizations have grown there. People are well and truly unbanked. They have no access to banking. But in the UK, you're right. I mean, there are about 2.5 million people. No, that's probably not right, actually. There are about 1.5 million people in the UK who don't have a bank account, which is, it sounds like a big number, but it's a relatively small number in the scheme of 50 to 60 million people. What you do have actually is something known as being underbanked. So this is having a bank account, but because of let's say your credit history, or your lack of a credit history, or perhaps or perhaps the fact that you aren't in regular employment, or you're in self-employment, you're unable to build a track record of a credit history with one of the credit reference agencies. It's very difficult for lending institutions to make loans to you. Business startups are classic, but also lots of individuals, so people who are either unemployed, self-employed, in part-time employment, people who move in and out of employment, people without savings, they struggle to register on these data registers. And so what you have is somebody with a bank account, but they aren't offered an overdraft, or they aren't offered a loan, or they aren't offered a credit card. And so while it might be very easy to say things like, well, you should always save before you borrow, it's actually quite hard to have the money to save when you're on a marginal income and you're hit with an unexpected bill, or when the washing machine breaks or the cooker breaks and you have to replace it immediately, or when you have to invest into something straight away. So that's why the market's grown. And I think one of the interesting things that we can notice over the last 5 years is that as banks and mainstream banks have continued to tighten their credit policies since 2008, you can almost to the letter, you can match the growth of the payday lending industry. So while doorstep lending has existed for hundreds of years, really the payday lending industry has accelerated because of a credit tightening in the last 5 to 6 years. And it's quite fascinating to see. These are people with bank accounts, but they have no access to banking products.
Okay. The other thing you said that surprised me was that the doorstep lending business is a registered business. It shows up in the FTSE. I always assumed it was a kind of underground business, that it wasn't legitimate. Are you telling me that people are actually employed and receive wages and all this kind of stuff for doing this kind of a job?
Absolutely. I mean, it's in its favor, I think you could say it's a regulated industry. These lenders have a consumer credit license. They have to sign up to certain protocols in terms of how they work and what they do. The market leader employs 55,000 people. I mean, that's a pretty big company across the country, and they are regulated. They charge a lot of money. I think there are some challenges about going around people's houses and lending money and taking cash. I don't know how you regulate things like that, but they are regulated, and they have protocols and processes in terms of how to do that. So it is an industry. There is another industry in the UK which you are right to talk about, which is a kind of the illegal money lending market, and it's big in the sense of it represents probably a couple of 100,000 people in the UK. But if I told you that in order to get a credit license, up until a couple of years ago, it would cost you £200, and that would be it. And
Really?
you could have a credit license. And a credit license would allow you to lend at whatever rate you felt was appropriate, whatever rate you wanted to do. There were protocols around collection, but you could pretty much manage your own collection strategy and however you wanted to do that. And you were unlikely ever to be visited by the regulator, at the time the Office of Fair Trading. I mean, it's a standing joke that it's easier to get a license to be a moneylender than it is to pass a driving test. And I haven't yet passed my driving test, and I've been a moneylender for 15 years in the UK. So, I mean, it is true that it used to be very, very easy to do this.
So does that mean that when you decided to start Fair Finance, although you had different motives and different values, that's all you had to do? You just register as your business as a money lending business?
Exactly. I mean, I, I, I essentially I took a consumer credit license, which is the money lending license that allows you to lend. I mean, if I'm totally honest with you, when I first started, I didn't even know you needed a money lending license. I didn't even know that. In fact, I was almost caught for being an illegal money lender because I hadn't actually got a license. Because like many people, I saw this once I began to realize the scale of the problem. What I really wanted to do was go out and solve it. So I essentially started taking money out and lending to people who were borrowing from various doorstep lenders or various, at the time, a very small number of payday lenders, and actually just started lending to them. My sense was, so one of the interesting things I discovered in Bangladesh is that while these money lenders who came to your houses might sound quite horrible, they were rarely men with baseball bats and Rottweilers. They were generally quite well-respected individuals who would spend the time to talk to you. And when I came back to the UK, I actually lived next door to a money lender, a doorstep collector, who was Tracy, and she lived on the estate, and her mother lived on the estate. So did her three grandkids. And one of the fascinating things is that she never forgot my name for as long as I lived on that estate. And she came to see me on my birthday, said hello to me every day. She remembered my mother's name. She knew everything about me. She was the kind of the perfect example of what I would call a relationship banker. She really understood and knew me. And so once I realized that, I kind of thought, well, I could do this. I could give this a go. Maybe I could start lending and figuring out how to do it cheaply, more responsibly, in a better way. And that's really where I started. I started lending out of an overdraft facility. I realized later I needed a credit license, which, as far as I could figure out, meant just more paperwork, but it allowed me to lend legally and responsibly to people. And I used that kind of concept of relationship-based lending to start finding a way to lend to people and understanding whether I could lend to them to help them create businesses and ideas, but also pay for things, to people who would traditionally never be touched by the banks, to people who had no data or who had terrible data. I would engage in a conversation about why they were excluded, why they weren't, why they had a bad credit history, and I would use that knowledge to start a lending process. And I did that for a number of years, building up a way of lending, which I then used to build and create Fair Finance in the coming years after that.
Let's look for a moment at Faisal the man. What is it about you, your background, your upbringing, your values that made you look at this problem and decide that you were the person who could offer a solution, rather than just shrug your shoulders, complain, and walk away as most of us do?
I think I've probably spent quite a lot of my time in a pub complaining about how rubbish the world is, and I think sometimes you kind of see something that you can do, and you think, well, I'll give it a go. And like I said to you, I really did go to Bangladesh and saw something that resonated with me. Not that it was not that I observed microfinance and thought how wonderful and amazing it was. That's not true. I do think it's amazing. What I really observed was I saw something that was very similar to what I'd seen in the UK, and a way of addressing it that nobody was really thinking about. I realized that actually, if you really sat and talked to people, perhaps they're not what the statistics tell you. Perhaps they are not the sum of what you've looked at their history. Perhaps they are someone today. And I suppose that's what really resonated with me. And I thought, I've seen my parents came to the UK from Bangladesh after the War of Independence. And, like any migrant, they started right at the bottom. My mum was cleaning shoes. My dad was working in the day, working nights. And I've seen the struggles that many migrant families have in terms of accessing finance, engaging with the banking industry, just being taken seriously, just being treated as to who they are. And I suppose that's what resonated most with me, that actually money and credit has become such a function of our lives, and yet we are predetermined as to whether we're allowed to be part of that world. And I suppose I just thought that was wrong. And I thought
Mm.
that's always been wrong. I think people are who they are, and you should engage and understand who they are before you judge who they are. And seeing this thing in Bangladesh where I observed and talked and spent time with moneylenders whose real job is just to find out who you are, and that's it, and then figure out what you need. And I thought, you know what? Why aren't more businesses built like that? Why aren't more businesses built on talking to people? And one of the things I do like doing is I do like talking to people. That's a character flaw that sees me spend far too much time in those pubs talking to too many people. And actually, I really enjoyed understanding what made people tick and why potentially they might not be the sum total of the statistics on a data file. And like with anything, if it begins to work, you might as well keep going until someone tells you it's wrong.
So rather than the traditional banking situation where people have to tick boxes and measure up to certain standards and they're regarded as either a good risk or a bad risk, you were using your gut instinct. You were actually trying to get into who the person was and deciding for yourself whether they were a risk or not before you would lend the money. Is that how it worked?
A little bit. I think there's kind of two parts of it. So I think this kind of links in probably to the other aspect that really interests me about this. So I think there's two parts. One of the interesting things I've seen looking back is that if I do focus groups with many of the clients that I work with, and I've spoken to many people through the process of the work, and I talk to them and I ask them, what is it you prioritize? What is it you think about when you want to borrow money or when you need to money? What are the most important things that you think are there? And invariably they say things like access. Can I even access a loan? Can I even access something? And these are people in communities where often bank branch closures have become such a regular sight that it's often difficult to access a bank. They talk about things like flexibility. Can if my income changes, can I change my repayment structure? Because these are people who are often paid 2 weeks, 3 weeks in cash, in checks, in various types of ways. And they often talk about things like simplicity and honesty. And I often challenge people. I often say to you, what's so simple and honest about the lenders that you're using at the moment, the money lenders, the doorstep lenders and payday lenders? And they say things like, a doorstep lender might sound expensive at 670% or 980, but actually it's only £20 a week for 50 weeks, and there's no penalty payments, there's no hidden charges. A payday loan might sound expensive at 4,500% or 5,000%, but actually it's only £30 100 every month. And there's a simplicity about it that people quite appreciate. And then they tell me invariably things like, the words that are really important to them are words like relationships. Do I know the person I'm engaging with? Because ultimately, do they respect me? And I think this is the kind of the core of what really fascinated me about this work, is that ultimately you've got people who don't feel they're being treated with respect by mainstream lenders. They are a bit worried to be on benefits and talk to their banker about needing to buy christening presents for their kids, or about having to borrow money for a school uniform, or even a computer, or a pair of trainers, or going on holiday, or whatever it is that they want to do. And it is that sense of being treated with respect in relationships. But what really resonated with me was that if you reduce those 6 principles I just said, what you've got is a very personalized, highly flexible, relationship-based service. And there is something quite interesting about those design principles, about thinking about products and services around that really interested me intellectually. That made me think that actually here's something that I really do understand. I do understand how to make these things work, and I have seen them work, and I do think people resonate with them. And if I could do that, if I could build a company on those kind of design principles for lending, could I create something that actually starts with lending but ultimately ends somewhere else? It really engages with you as a person to figure out, how would you like your financial services to be delivered? Not cheaply, simply, but actually with a relationship, with a respect, with a flexibility, with an access designed around you. And I think, if I'm honest, it was that intellectual challenge of trying to do that in a market that, let's face it, is quite a dirty market when it comes down to it, where people are treated badly, people are taken advantage of, and they are the people for whom really they have no other options. And so it seemed to me a really fascinating and exciting opportunity to have a go. And to this day, still not very many people are challenging me, which I find quite odd. Well, they are challenging me, but not in the way that I'm doing it.
Just expand on that a little. What do you mean by people are not challenging you?
Well, I think that payday lenders charging 5,000 or 6,000% and doorstep lenders charging 600 or 900% are evidence of a market failure. And what's interested me is that you don't have to charge that much. You can do it for a lot cheaper, not by being non-profit. You can just do it for a lot cheaper by running a better service, a better product. You end up with lower defaults, better client retention, more stronger relationships with people, and you don't have to charge anywhere near those figures. And what's interesting to me is that nobody else is doing that. Everybody else finds it so easy to open a starter payday firm and charge 5, 6, 7,000%, or another doorstep firm charging 700, 800%. Nobody is actually interested to undercut them. And that to me is evidence of a massive market failure that I hope Fair Finance will be able to address in London, at least.
Yes, I mean that does seem to be something I find quite extraordinary, that people are going into this sort of business. You know, when some of the payday loan companies started, they went straight in at the highest possible rate, and nobody was thinking, as you obviously have, of undercutting all of this and still being able to make a profitable business, which you are obviously doing.
Yeah, and it's taken some time. I mean, I spent from 2000 to 2005 really testing and designing different ideas, different ways of doing it, and I've really worked from 2005 to 2014 to kind of to build up those ideas to a level where they're scalable, sustainable, profitable, and viable. And it's hard, and I don't know how many people will find the kind of backers and investors who are willing to take that type of commitment to make those types of systemic changes in the market, because it doesn't happen overnight. And one of the things that I imagine is that lots of people think that you can make a very quick buck in this market, and what we're seeing is the impact of making a quick buck. Rather than lending responsibly, you end up with companies that compete simply on speed and nothing else. And it's very difficult to prove that you're being a responsible lender if all you're doing is trading on speed. And I think that just takes advantage of a broken market.
So you said that you over this time you have created a scalable and sustainable business. Has any of that meant that you have gone away from this relationship building? You know, have you had to sacrifice some of that in order to make it scalable and sustainable?
I think what you begin to understand. So there's a couple of things that I've designed the business around. So one is I believe that people pay because they want to pay, and I say that because I don't think income is a determinant of your ability to is a determinant of your repayment skills. I think rich people default just as much as poor people. I think it's about whether you want to, and I also think that people prioritize, and I think they prioritize based on either what's in front of them or how they understand what's important to them. So if I want my business to be successful, I have to have everything designed around those bits. So the core of my business will never change from being face-to-face, ever. There are parts of it that don't have to be face-to-face once we built a relationship with somebody, so an online presence, a telephone-based approach, a text-based approach, but ultimately at the root of it is a face-to-face connection with every single person that we meet, and a close connection with the person who makes you the loan. And that's really important to have done, because I think that's the reason why we've been able to scale and keep defaults low, scale and keep retention high, scale and keep absolutely the growth rates at the levels that we've been able to do. And so we have these kind of interesting numbers. So my sense is that my loan officers or my loan advisors or the staff in Fair Finance, I give them a maximum number of clients that they're allowed to work with in a year. And if they work with more than that, I'll cut their salary. So an inverse bonus. And the rationale behind that is that if we're a relationship-based company, if we are a company that is about that, then there is a limit on the amount of time that you can spend with people. And if all you want to do is meet more and more people, you become a transactional-based company. So we limit the amount of time that a staff member, the number of people that a staff member is supposed to engage with, so that they can really work on building those relationships with people, so that we can make sure they end up with the right kind of products, whether that's savings products, advice, support, assistance, a loan, whatever it is, in terms of making their lives better.
Wow, that's quite taken my breath away. That's an extraordinary way to look at it. Just superb. You mentioned earlier about your backers, finding backers who are prepared to go along with you with these risks. So what kind of people have invested in Fair Finance, and why are they so different to the people who invest in Wonga and other payday loan companies?
So Fair Finance is kind of a company of two halves, I think, or a company of two ages. The first 4 years of Fair Finance was really financed by myself with very small loans from friends and family and people, a few grants, a couple of very small things, but we made the business move into, we tried to prove the model in the first 5 years without really growing very big, so we did it at a very, very small scale. We really started to grow rapidly from about 2008, 2009, when we went out and we looked for two very different types of funding. We looked for money to grow our loan book, so we wanted to borrow money from the banks to scale up our loan book to be very big, and we wanted it on commercial terms, and we wanted to find some investors who were willing to back the scale of the team. So it really paid for operations, working capital, helping us expand to the right places. And what we wanted to do was we didn't want to sell, we didn't really want to sell traditional equity. We didn't want to give people a kind of an ownership stake in the company. So one of the fears I always had was that we have designed a model that's so successful in a market that is extremely dirty. And the temptation to change Fair Finance's rates to just a bit below the competitors, rather than we are 1/20th of our closest competitor. And that's a statement. That's a really important thing for us to be, because we don't need to be more. We can be profitable at this rate. Finding people who believe that and wish to stay the course to do that was tough. And it took me about a year and a half to find essentially a group of individuals and a couple of small institutions who were willing to put in money for kind of 10-year time horizons with a fixed rate of return. So our investors, very much like our loan officers, they have a capped rate of return. So they will not receive more than a 5% per annum return on their investment, which I think is more than enough. And their investments are for 10 years. So they receive their interest all the way through, and they receive their capital back at the end of that 10-year time horizon. They'll actually be paid out sooner because we've been growing so quickly. And we raised about £1 million, £1.5 million, which allowed me to grow a company from, at that time, 3 or 4 people to 40 people, and covering London from 1 branch to 6. And then we raised about £3 or £4 million from a group of banks to grow our loan book. And that's been the model of our growth. So we look for individuals who are committed to our mission, and we offer them a kind of a stake, a commitment that we will be able to repay them and support them, and we sign long-term kind of loan investment contracts with them. And we look at them as investors. I mean, we meet with them every quarter, we share data with them, we engage with them very carefully about how to grow our business. So every one of our stakeholders, because they're invested financially and personally, socially in a sense, we have people who advise us on our retail expansion, people who mentor some of our staff, people who help us with introductions indoors and finding new ways of getting into places. And I think that's been the most important thing in terms of scaling my business.
Yeah, I can imagine it must have been very tough finding the right people. It's not something that's going to appeal to most angel investors.
So one of the most interesting conversations I had was with an individual who was extremely rich and basically had taken a look at our business and said, "Look, Faisal, I can make you a very rich man very quickly, but this is what we need to do." ... And I quickly realised that actually he wasn't really into the mission or the business of what we were trying to achieve, but he really saw it as another trick in a market that was actually quite full of tricks. But yeah, it took some time. And the nice thing has been that was a fundraising we did in 2009, and I can tell you that we've built such a strong following with people. We did a similar fundraising a year ago where we launched a new product, and we raised the money in less than a month from another group of angel investors. And I think what we're doing is we're creating a market of people who are committed financially and socially, so that when we do our next fundraise to scale even bigger, I think it won't take me a year. I think it will take a lot less time, actually.
There are other organisations, community lending organisations and things like that, again have existed for many, many years, hundreds of years. Do you see that those organisations will develop in a similar sort of way, or will other organisations come along more on the model of fair finance? How do you see the future developing along those lines?
I think you're right. There are about, I think in the UK, there are about 300, maybe 200-300 credit unions which are offering personal finance to many people in some small communities, some bigger communities. And there is a growing movement of what are known as community development finance bodies, organisations, which are offering similar to fair finance loans to businesses as well, and others around the country. There's about, I think, 60 or 70 of those. I think, if I'm totally honest with you, many of those organisations have suffered because they're very narrow-minded in where they're focused, so they're very localised. And because of that, they've often been funded by local authorities in the public sector. And that's been very positive for many. They've been able to build up a business. And I think what we've tried to do at Fair Finance is say, we don't really need public money. We think this is a business opportunity. We think it's a tough business opportunity. And actually, if we could do it right, there is enough private money out there to do something. There are lots of individuals who are committed to changing the way the finance system works. And there are lots of bankers, actually, who would much prefer this. I mean, if we go back to that previous point where I said that most people were underbanked, they have a bank account. So people like Santander who back us are more keen to back us than worry that their clients are going to go to payday lenders. So there is an appetite of social investors and commercial investors who'd like to find alternatives to payday and otherwise. I mean, I hope that other organizations around the country will look at fair finance and say, if we've historically been subsidized by the state, there is a way of doing it differently. There is a market of people out there who'd be willing to back this, but we need to work really hard and treat it like a business, not like a social project. It has to really work and stand on its own 2 feet. And that is tough. It is really hard to run a company in a market where people are used to having bailouts, essentially. Bailouts from the local authority, bailouts from the government, all of those kind of things. And actually staying true to wanting to run a sustainable and social business is quite a challenge. I mean, I hope more do. I think more are. We work with quite a few around the country who are changing the way they're thinking and have started to do some work around this. I think the government as well as individuals have started to talk more about social investment as a way of offering a new market, because ultimately this is about access to capital and access to entrepreneurialism.
Mm. And given the state of banking in the world generally at the moment, and especially in the UK, why is it, do you think, that some banks actually see this, that they can grasp that bigger picture, and others are still saying no, well, not even saying no, but perhaps not even considering that there is another way to do things?
I think it probably, to be fair to the banks, I think it probably sits in two halves. So I think on one side, I think many of the banks in the UK are just struggling at the moment anyway. I think that's probably quite true for many of them. They're struggling to confirm and sort their business model. But I would also argue that many of them are not really being given any options. When we went to do our fundraising, we talked to every single bank, and most of them had either never heard of this other option. They thought that if you were to lend to the community we were lending to, so to give you an example, if you think of their credit scores, they are on the kind of credit scores where there is no reason to lend to these people. And they were thinking that if you wanted to lend to these people, their algorithms would say that you need to charge a minimum of 1,000, and if you charged 1,000, you have a viable business. What we were doing is saying, no, you don't. You need to charge 59% or 39% or whatever it is that we're charging, and you can undercut it massively. They intellectually just couldn't get their heads around that this was potentially possible. The very fact that somebody was doing it just felt strange and odd to them. So I think there's one side about, I think, banks having a little bit of a lack of imagination about understanding you could do it differently. But to be fair, I think too few people have tried to make this work. Too few organizations have tried to show that you can make an alternative viable challenge. And I say this as I spent a big chunk of my life campaigning, either smashing my head against a brick wall or chaining myself to things and trying to convince people that change needs to be done. And I've had a bigger change by showing how change can be done, by running a company and actually making things happen. And that's what I think is kind of been lacking. And if there's anything that all of the people who are annoyed about the growth of the high-cost credit market have, is that they spend far too long being annoyed about it and not long enough doing something about it. And sadly, we're one of a very small number of people doing something about it, which is a bit frustrating. And I think if more did, they would be surprised how many banks would be desperate to find a way of backing them.
So if the people who are annoyed about it wanted to do something about it, how would they go about it? I mean, not everyone has your skill and your drive and your vision to start another business like yours, to follow in your footsteps almost. Is there something that those individuals can do? I'm thinking in particular, I know there are several crowdfunding sources for almost like a credit union, but where people can put in very small amounts of money, and that's managed in a different way to other kind of business financing, for example, and they do make loans to individuals as well as businesses. So is that a way that other people can get into changing the way finance is managed?
I mean, I think the crowdfunding market is a really, really interesting way of taking more control of your assets. I think more of that is definitely really, really positive. I'd say two things. I'd say one, yes, people should do more of that. The other, I would say, if they're not willing to start or not able to start something, is actually looking to invest directly in people who would, because there is a growing market of social investment, and while there are a few of the crowdfunding platforms to talk about individual transactions, there are still too few organisations on the ground making those changes and making those delivery changes. So there is a trade body called the Community Development Finance Association, where lots of people who are interested in this space in the different regions, whether they're in Cambridge or in Yorkshire or in Wales, have come together to talk. And there are many organisations there that are looking for smart people to join the board, interested, committed investors to help them scale into interesting, smart ways, or they're looking for people to help them stretch their thinking into new ways. So I think there's a lot of things that you could do. You could put your money into useful places. You could get behind some of these organisations, or I would be really happy to help people scale up fair finance in other parts of the country. I mean, that's not something that I'm not averse to. In fact, it's something that I'm very much keen to do. I'd very much like fair finance to be in all of the country doing something different, and that will be a bigger ambition of mine.
Okay, so this is something that where you would roll out the model that you've already proved works, and help people to start it up in different parts of the country.
Yeah, we'd love to. That's exactly what we'd love to. I mean, I spent the last 10 years trying to convince other people in London to do something, and I've just been frustrated by the lack of people doing it. I mean, if I'm honest with you, fair finance is we're tiny. We have 15,000 clients. We're almost doubling in size this year again and again the next year. But if I told you that what I did in a year, the payday lending industry did in a week, you kind of get a sense of how far we are away from this sector, and we need more people doing things. And I would love that to happen. And if I can help more people do more things, I would love to be part of that. At some point, we'll be big enough to get there, but we're not going to get there in a very quick hurry.
Okay, but is fair finance set up to receive investment from small investors, or would it really just be banks and much bigger institutions that would be eligible for that kind of thing? Is that what you can handle?
Yeah, well, nearly all of our investment actually is from individuals. We only have one institution who are backing us. So actually, we have a very small number of investors. So we have 20 investors in fair finance, each with individual relationships with us, which were all angel investors into the process. From next year, we will be big enough to start offering a much bigger retail offering to people as a way of getting involved and being part of it. So yes, there'll be some options next year. And so that's something that we're going to look forward to helping to give out on our next fundraising challenge.
Fantastic. Is there anything else that you'd like to share with us, Faisel, before we end the interview?
Only that this is the only thing I would say is that I was never really trained as a banker, which is probably why I've been able to become a moneylender. And I was never really trained to understand finance in this way, which is probably why I'm pretty good at doing what I'm doing at the moment. I think you sometimes need to look from outside to come in. And what I would say to anyone who is kind of listening or watching is that actually you don't really need to be a banker or a financier to disrupt this market. There are so many opportunities and the market is so broken. It just needs more people with a smart brain and a commitment to do something. And I would be really happy to help anyone around the country doing it and be involved in it. And if possible, they should check our website and get in touch. And I'd love to find a way of having fair finance type things in other parts of the country that are appropriate and relevant to people's localities and locations.
Great, that's a fantastic message to end on. One of the things that is just going around in my head is that I find it very hard to think of a moneylender as someone who does good. It's been such a dirty word for so long, and you've really turned that on its head, haven't you?
What I'd say is, if you think about the origins, I mean, what we're doing is we're giving credit to people, and if you think about what the origins of the word credit is, it's from the Latin credo, to trust, and actually all we're doing is we're bringing trust back at the place where it should start from, and that's kind of what this is. It's a relationship-based trust business, and people listen to us and take our advice because they trust us. People pay us back because they trust us. People will take pensions and build insurance and do all of the things that we hope that they would do to make better financial decisions because they trust us. And that's what really the whole of the financial system should be based on.
You know what? I'm giving a talk tomorrow morning about trust. and you've just given me a whole lot of new material to add into that. I'm going to have to go away and rewrite my speech. Faisal, it has been a joy talking to you. Getting even more information and finding out more details about your business. I'm convinced that you're going to go from strength to strength, and I can't wait to see branches of Fair Finance all over this country. And as you say, to offer a real challenge to the companies that are in it for a quick buck and not to make a difference.
Thank you. It's been a pleasure. Really nice to see you, and hopefully we get to meet next time face to face.
I'm sure we will. Thanks again for joining us.
Bye.